Your host today will be Mario Acosta. He's FLAR's head of investments. He will be accompanied by Mr. Carlos Giraldo. He's our chief economist. Without any further ado, I wish you a wonderful day and a very productive meeting, and I leave you with Mr. Mario Acosta.
Thank you, Iker, and thank you all for joining us today. And welcome to our first chapter of the Cartagena Talks. Um, Today we are delighted to have with us Mr. Shilo. Most of you already know him. For those who don't, she is the senior economist for Greater China of BNP Paribas Asset Management based in Hong Kong. He joined BNP back in 2010, and prior to that, he was the head of overseas investment at Ping An of China Asset Management. His other positions in Asia included Asia Research Head of the British Private Property Fund Grosvenor, Chief Economist and Strategist for Asia at Standard Chartered Bank, and the Research Director for Greater China at HSBC in Hong Kong. Of course, the main subject of this conversation is going to be China, a country that has become extremely important for global financial markets and global economy over the last decades, and especially over the last years. Just to give you a couple of examples, back 2 years ago, 1 year ago, all the markets were turning around China. We were living the most challenging months of the trade war between the U.S. and China back then. And right now we are in the middle of a recession that could be deeper than the global financial crisis, and a recession that was caused by the COVID-19 pandemic, an issue that, of course, is not a unique problem of China. It is a global issue, but given the fact that the virus started in China and the fact that China is one of the only countries that managed to flatten the infection curve, well, the role that China plays in all this crisis is significant. And finally, as you already know, FLAR's main purpose is to contribute to macroeconomic stability in Latin America, and one of our objectives is to improve investment conditions of reserve management in the region. China is opening its financial markets to international investors to the point that many central banks and official institutions are including Chinese assets into their investment portfolios. So we believe that now is more important than ever to understand the Chinese economy and its dynamics. And for all these reasons, we believe that it's key to start bringing these subjects within this group of reserve managers. We have the privilege to have with us an expert that will guide us through the perspectives of the Chinese economy. And with no more introductions, again, thanks a lot for joining us today. We really appreciate it, and welcome. The stage is all yours.
Thank you very much, Mario, for a wonderful introduction, and thank you, Eka, for the introduction of the introduction. Good morning, everyone. See you in Latin America. I'm Chilo with BNP Paribas Asset Management based in Hong Kong. Now, as Mario mentioned just now that, the whole world is going through an economic slowdown, recession, quite likely. That could be worse than the global financial crisis back in 2008, 2009. Now, that is also true for China. And indeed, the Chinese economic outlook is facing historic challenge to growth or to recovery. It is true that China was the first country that got into the COVID-19 pandemic, but it's also the first country to get out. But then the getting out process is not as easy or as not as smooth as expected just over a month ago. About a month ago, the world was still expecting China to stage a V-shaped rebound after the COVID-19 crisis is over. But now, just over the past 3-4 weeks, things have changed, opinion have changed as well. So as my slide on page 2 shows, there's a chart there that COVID-19's economic damage on China's GDP was more than twice as large as the damage by the global financial crisis at GFC. Which means that the economic recovery this year is starting at a much lower point. For example, if you look at the chart, I presume the chart is, you can see the chart because I haven't seen my chart on my slide, on my screen. So that's page 2 on the presentation deck. So I presume the slide's on. So during the global financial crisis, in the first quarter of 2008, China was growing at 11.5%, and then a year later, there's the slide. Okay, page 2, please. And a year later, in the first quarter of 2009, exactly, this is the chart. In a year later, in the first quarter of 2009, China's growth was only 6.4%. So the hit by the GFC on Chinese GDP growth within a year was 5.1 percentage points. But then when you look at the blue line in the chart here, last year, first quarter, China was growing at 6.4%. But then this past first quarter, a year later, China GDP was contracting at minus 6.8%. So the hit by coronavirus on the Chinese growth this time is 13.2 percentage points. So there's a much deeper economic damage caused by this health crisis than the GFC, back some 10 years ago. So that means that China will be climbing out of this slowdown from a very low base. So that's not easy. And then to aggravate that difficulty, the global environment is less favorable today. According to the IMF forecast, global economy is going to contract by 3% in 2020. So that's not going to help much. And now that global environment actually is underscoring one of the major macroeconomic risks that China is facing in this recovery process, and that is the export sector. So if we turn to page 3, I want to focus a little bit on the trade impact on China, which I call the feedback impact of COVID-19 from the demand side, because China export growth has a high correlation with GDP growth in Europe and the US. And these are the two largest markets, export markets for China. So that's why their economic health is very important, and Chinese exports could be hit as hard or probably even worse this time than the 2008-2009 GFC. So the correlation between Chinese growth and Chinese export growth and the GDP growth of Europe and the US is shown in the two charts on this page here. Top chart is Europe. The lower chart is the US. The red line in both charts are just China's export growth, year-over-year growth. And then the dark line is the European GDP growth on the top chart, and the dark line in the lower chart is the US GDP growth. And then the light blue line is just a regression using European and US GDP growth to explain China's export growth. So you can see the two lines, the dark and the light blue lines, are quite close together, which shows a very close correlation between Chinese export growth and the economic growth in the US and Europe. Now, as you can see in the left side of those charts, there was this big drop in growth in Chinese export growth, and that was the GFC. And this time, if you look at the right side, people are now talking about significant slowdown, recession in this G2 country, which in turn means that Chinese exports are going to be hit very hard. As a matter of fact, the market is now talking about a drop in Chinese export growth between 20 and 45% in the second quarter of this year. And this is something that the market hasn't allowed for until recently. Now, if that were true, then that would cut off 4 to 8 percentage points from China's second quarter GDP growth this year. So that would be a big drag on growth, a big damage on Chinese growth this year. Now, and on top of this health crisis, don't forget we still have a trade war going on with the US. Although the trade war risk has stabilized somewhat, and now the focus is not so much on the trade war, which I think it will come back, but then the risk is still there. So the trade war is going to add further contractionary pressure on China. Now, last but not least, China's exports to developed markets are also linked quite closely to the investment cycles. About half of Chinese exports to the US and 45% of China's exports to the world are machinery, equipment, capital goods kind of exports. So when the investment sectors are hit in these other countries, that's going to aggravate China's export growth damage. So that's the demand side. So China is facing significant challenge, in terms of a collapse in global demand going forward, especially in the second quarter of this year. Now, if you turn to page 4, this is another channel that would affect China's recovery, and that's from the supply side of trade. And that's basically the supply chains. So I call it the feedback effect of COVID-19 from the supply chain area. Now, China imports intermediate goods and raw materials for local usage, for re-export usage. And there's a lot of these intermediate goods and capital goods, raw materials that China imports each year. The top chart on this page shows China's top 20 raw material importing countries. And as you can see, there are a few Latin American countries there. Brazil is right on the right-hand side there. There's Chile, there's Peru, and so on. So the point here is that, with all these big import demand from China of raw materials, if there is any, shutdown, disruption in trade, in production in these countries, China is not going to get those raw materials for production. Right. And then in terms of intermediate and capital goods, I want to focus more on EU and US here, because these are the two big markets that China exports are going to. So China also imports a lot from Europe and the US in terms of intermediate and capital goods. But then the exposure of China to the imports of capital goods from these two big economies is moderate, not very significant, but still about 12% of total Chinese imports each year come from of the capital goods come from US and Europe. So the point here is very simple, that with the unprecedented shutdown of normal economic activities across Europe, US, and a number of emerging markets, like Brazil, Chile, Peru, so on and so forth, that's going to cause supply disruption to China, which means that China's economic normalization will be hindered. So that's the supply side impact of this COVID-19 on China's economy. So put together the demand supply side, this is a very big challenge for China to face in the coming months, quarters, when it climbs out of the economic slowdown because of this health crisis. Now, that brings us to the policy part. So there is a political aspect to the growth recovery. Now, if we turn to page 5, you probably know that there is a policy goal, this government. Beijing still wants to achieve that policy goal of doubling this year. China's GDP will need to grow by 5.6% this year. Now that, with a contraction of 6.8% year over year in GDP, that's basically out of reach if there's no policy shift. Which means that if Beijing still continues to use its selective easing policy, there's no way that China can achieve that 5.6% growth rate, which is needed to achieve the policy goal of doubling China's GDP. So let's assume Beijing doesn't shift policy and keep using the moderate selective policy. We have minus 0.6% growth in the first quarter, and assume second quarter rebounds back to 0%, which is a big swing already. And the third quarter grows by 6.5% year over year, and the fourth quarter by 7%. even with these pretty positive assumptions, full year growth in China would only be 2.1%. That's significantly less than the 5.6% that is needed to double real GDP. So that's basically, there's no way to achieve that policy goal if Beijing doesn't shift policy. So on the other hand, that means from a policy perspective, there is mounting pressure on Beijing to ease policy more aggressively than it has been doing. And I believe things might be changing. So before I get into that, let's look at some possible numbers for growth if Beijing does ease more aggressively. For example, if Beijing boosts infrastructure investment growth to 10% year over year versus currently is about 4% a year. All right? So if infrastructure spending in China can grow by 10% year over year for the next quarter, that will add at least 3 percentage points, according to my calculation. That will add 3 percentage points to the second quarter's GDP growth this year. So if you look at the table I put together, that is the middle column, that infrastructure investment grows by 10% year over year. So with the first quarter minus 0.6%, second quarter there will be 3% growth instead of 0, my original assumption. Right? And then the same assumption for the third quarter to grow 6.5%, 7% for fourth quarter. Now that would push up, that 10% growth in infrastructure spending would push up growth, the full year growth to 2.8% from the 2.1% no policy scenario. If infrastructure investment can grow faster, say at 20% year over year for 3 months in the second quarter, full year growth can go up to 3.6%. So I think my point here is that first, there are things that Beijing can do pretty easily, like boosting infrastructure investment. It has not been doing that quite aggressively, because when you look at infrastructure investment so far, it's been growing at 4.4 and 5%, on an annual rate, which is very, very slow. So Beijing can do more on that. Now, I mentioned just now that things may be changing, and I think Beijing may be caving in to the pressure for more aggressive easing because of the economic damages from the COVID-19 plus the trade war with the US. Now, how do we know? We don't really know. But there are some indications that we can make an educated guess. If you turn to page 6, I've got some indicators there that when you look at the top chart on the left, that's the PBOC 7-day reverse repo rate. Right? That's the proxy to the monetary policy stance. And recently, that rate starts coming down. The PBOC starts injecting more liquidity to push down the reverse repo rate. And as you can see in the chart there very clearly, after more than a year of sort of, pretty stable 2.5% reverse repo rate, the rate is now coming down towards 2%, and I would believe that it will go below 2% soon. Right, so that is an indication that monetary policy is getting more aggressive. And then you look across on the right-hand side top chart there, total credit growth in the past month went up to a 2-year high of 11.5%, 11.7%, whatever it is. So that is reflecting, again, more liquidity going into the system, and part of that increase in total liquidity comes from the shadow banking activity, which has been under a lot of stress since 2017, when Beijing started the deleveraging process. Because when Beijing started the deleveraging process in 2017, it aimed at reining in shadow banking. So that took away a lot of liquidity from the shadow bank market. And now that market is coming back, as you can see in the lower chart on the right-hand side. The red line there is rising. So that is also an indication that Beijing is now putting the deleveraging process on the shelf, because downward pressure on growth is too big. The other indicator is fiscal spending. Where does the money come from? There's market talks now that Beijing intends to increase the special bond issuance quota for the local governments to 3 to 4 trillion this year from only 2 trillion last year. And then there's also a speculation that the central government for more than 20 years will start also issuing special bonds in the neighborhood of 1 to 2 trillion. So we are talking about a potential 4 to 6 trillion special bond issue coming to the market, tapping the capital market, mobilizing Chinese savings, and put that money into the crisis fighting easing measures, including infrastructure spending, including boosting consumption, cutting taxes, and so on and so forth. So these indicators actually, I take them as sort of some initial signs that things might be changing in the mindset in Beijing, that they might be moving to a much more aggressive easing mode in the coming months. And this aggressive easing mode currently is still not priced in by the market. So there's some gap between market expectation and what Beijing will be delivering here. So we'll know in a few weeks, because the National People's Congress will sit next month on the 21st of May for a week. So that NPC, the National People's Congress, was supposed to be set in early March, but because of the health crisis, it was been postponed. So we'll know much more clearly what Beijing's thinking is during the NPC, because they will announce their policy intention. So now let me just finish up this quick overview by turning to page 7, talking quickly about this forecast era. Now, the forecast for China's growth is all over the place, and the market has gone very negative on China's growth, with some brokerage houses calling for 1.3% growth this year, which I think is too weak. It's too weak for political tolerance by Beijing. From my calculation that we discussed a few slides before, with all this more aggressive policy coming on board, I believe currently, we are looking at between 3 and 4% growth range, with some downside risk. So I would say between 2 and 4%, this growth range would be a reasonable guess at this point for this year's growth. Now, the forecast margin of error is much bigger than usual. The top chart on this page here just shows the growth trajectory, the growth forecast profile, year over year and quarter over quarter, without policy shift. Right, so that's the case when year over year growth this year would be 2.1% if there's no policy shift. But if there's policy shift, and if there is enough policy easing to push infrastructure spending to grow by 10% or maybe even 20% for the next few months, that will boost second quarter GDP growth by at least 3 percentage points. And the lower chart shows the year-over-year growth under these two scenarios of infrastructure investment. The middle one, when infrastructure investment grows by 10% for a few months in the second quarter, we could get full year GDP growth at 2.8%. And if Beijing is more aggressive and push infrastructure spending, make it grow by 20% in the second quarter, so then full year growth will go up to 3.6%. So the margin of error is big, because on the downside, if there's a deeper global recession, there's a second wave of outbreak in China of the COVID-19, we could have growth in China this year, weaker than expected. On the other hand, if Beijing comes up with a more aggressive stimulus package, much more aggressive than everybody expects, and if the global outbreak comes under control faster, no more shutdowns, no more disruption, then we could get stronger global growth. We could also get stronger China growth. So with that, I'm going to stop here. I think I just stick with a 20-minute slot, and we can get started with our discussion. Thank you.
Naoshi, thanks a lot to you. Very interesting, and as always, we have already started to receive some questions, but before I transmit them to you, we always like to relate these the things that are going on the markets, and especially the slowdown that we are seeing in China and the recession that we are seeing in in the global economy, and we would like to relate it to what's the impact and what is happening specifically in Latin America. For that, I will give you the microphone, Carlos, to give us some color regarding this situation, and of course, to give you the opportunity to ask a couple of questions to Mr. Shane.
Okay. Thanks, Mario. It's a great pleasure to be here in our virtual Cartagena Talks with all of you. And thank you very much, Chi, for your interesting and complete presentation about China.
Pleasure.
Clearly, I think the China's future growth faces many challenges, as you illustrated very well. Particularly, the rest of the world economy is unable to demand Chinese products because of the contraction. And I want to highlight other important and challenging aspect that is linked to what you mentioned about the how to finance growth in China and in general in the emerging markets. This factor is regards to capital flows from out of China and the emerging economies in general. According to the most recent report on capital flows for the Institute of International Finance, non-resident portfolio flows from emerging markets fell roughly $83 billion during March, including outflows from China. This is an important figure. However, considering the magnitude of the potential damage caused by COVID-19 to the emerging market economies, because as a whole, they are highly vulnerable to this shock, as is stated by many international organizations and international analysts. Do you think this magnitude could increase in the coming months substantially? And what do you believe could be the reasons behind this behavior? This is an important factor that we want to maybe to listen to your opinion.
Yep. About capital outflows. I haven't looked at the detailed numbers, but from what you told me that there's capital outflows coming out of China. There's always capital outflows coming out of China. It depends on how much. Now, when I looked at various indicators, like the renminbi exchange rate, it hasn't moved much. It's around 7 against dollar, and it's done actually quite well given all this crisis and loss of confidence. And secondly, so that is one indicator that shows the amount of capital outflows from China is not in massive scale like what it happened during 2015 and 2016. Those 2 years, if you remember, there were massive capital outflows from China. The market estimated between those 2 years, the 18 months, China lost almost $1 trillion capital within those months. So this time, I don't think this is the case because first, there's not much pressure on the exchange rate. And underscoring the exchange rate stability is the PBOC hasn't really done much intervention. As compared to 2015 and 2016, there was massive intervention by the PBOC to support the RMB exchange rate and prevent it from falling too much. It still fell, but then it was falling. It had fallen much less than it would have been if the PBOC hadn't intervened. But this time, when you look at the PBOC, so far if there were any intervention, it would be on the upside there to curb the RMB from going up, to sort of keep it stable. So I think the capital outflows issue is always there. Whatever capital outflows that we've seen, those would be the bulk of it would be all the approved Chinese investment overseas. And you probably are aware that there are many Chinese companies, especially state companies, who are taking advantage of the global asset price weakness and to go shopping, buying up overseas assets, especially strategic assets like natural resources and so on. And also there's investment flowing out of China through the Belt and Road Initiative. There's investment projects approved by Beijing for companies to invest outside of China into the Belt and Road countries, some of which are in Latin America, but most of them are, in Asia and in Africa and Central Asia, all over the place. So when you add up all these projects and also the purchase of overseas assets by Chinese companies, by whether they're state or private, that explains basically all the capital outflows. So I don't think there is any, at this point, this time around, I don't think there is any danger of uncontrolled capital outflow like what happened in 2015 and 2016. So there's always this need for Chinese investors, whether they are individuals or companies, to diversify investment. I think that's a pretty natural thing to do, diversifying their investment to diversify income, to diversify risk, and so on and so forth. When I was with Ping An Asset Management more than 10 years ago, I remember I was there for 4.5 years. I spent 3 years in educating Ping An senior management and the Chinese authorities the benefit of investment diversification. So that was more than 10 years ago. So, momentum builds up. So there's this natural need for Chinese investment to diversify overseas. So the Chinese are doing that. I think that's natural. I don't think this time around we've seen a lot of uncontrollable capital outflow, which we did see in 2015 and 2016.
Thank you, Chief. Very interesting. Maybe it's one of the risks ahead for all, not only for China, but also for emerging markets. But up to now, the magnitude is apparently under control of these outflows. And now turning to other interesting point that is linked to what you mentioned about the more expansionary monetary policy. I create the background for Latin America. In Latin America is one of the most vulnerable regions to the COVID-19 shock. We are experiencing at the same time a negative terms of trade shock, particularly in South American countries. This is in part linked to lower Chinese demand. At the same time, we are experiencing the effects of the drop in external demand from China and the US, and the COVID-19 shock inside our economies. Our region is fragile not only because of relatively lower healthcare capacity, but also because of the crisis. Has caused the region with a very low growth for several consecutive years. These circumstances are reflected in the recent 2020 GDP forecast for the region from different organizations. For example, the IMF World Economy Outlook is currently forecasting a 5.2 drop in the region's GDP for this year, for the current year. But at the same time, we have seen an active response from the regional economic authorities, not only in terms of the monetary policy, but also on the fiscal front, considering the important constraints some countries are facing today. In this juncture, perhaps our region has one advantage emerging from the fact that the COVID-19 arrived later to our region. Bearing this in mind, I have a question, and is the following. Since a real shock, that is the COVID-19 shock in principle, could turn into a financial stability problem rapidly, considering that this risk is higher in a context of high corporate debt, as is the case in China and some Latin American economies. What do you think is maybe the main lesson from the Chinese experience for some Latin American countries, taking into account that the monetary policy could be very expansionary in the next month? I would like to listen to your thoughts about that, and maybe to extract some lessons from this fact.
Well, indeed, the debt concern is quite important, especially as you mentioned, for countries that have high debt to GDP ratios. Now, the global authorities have always had that problem in mind, of course, and otherwise the US will not lead the world to get into QE again. So now we have QE in America, we have QE in Europe, we always have QE in Japan, And many other countries are, pushing rates to the floor towards zero, and also using fiscal expansion to contain the growth damages. The point is very clear that they would want, all these monetary authorities would want significant monetary easing to flood the world with liquidity to hopefully put a floor on the potential bankruptcy and defaults of countries and companies which have high debt. So from an investment perspective, I think it's natural to look at when we assess the relative riskiness of different economies, different markets. The first thing that we would tend to look at is to look at whether a country, an economy has a twin deficit, current account and fiscal deficit, and then whether the country has a very high foreign debt to GDP, and within the foreign debt burden, whether there's a high portion of short-term foreign debt, and then whether a country has high inflation. So these 4 or 5 major indicators would help us quickly to screen the countries and try to figure out which one would be more vulnerable in terms of a debt currency crisis than others. Now in Asia, I don't know much about Latin America in details, but in Asia, I have a bit more knowledge. There are 3 economies that are quite vulnerable to the COVID-19 inflicted financial crisis down the road if there's a financial crisis. So these are India, Indonesia, and the Philippines. Because these 3 countries, they have problems or in all the indicators that I talked about. They have a twin deficit, current account deficit, they have fiscal deficit, they have high foreign debt, although not as high today as they were back in 1980, the Asian crisis. Still high foreign debt. And then a large chunk of the foreign debt is short term. And then they have high inflation rate as well. So when you put all this together from an investor's perspective, like us, or like yourself, if you invest in those countries, your confidence in those countries with all these macro problems will certainly be much lower than your confidence in the other economies that have much stronger fundamentals. So which means that the probability of capital outflows from these countries that have weaker fundamentals, they will have a higher probability of capital flight, capital outflow, capital flight, whatever, because foreign investors will just get their money out faster from these economies. Then back to China, the country that I know a bit more than others. There is also a high debt problem in China, as we all know, from all aspects now, except the government. Now, central government debt in China is still quite low. It's about 30% of GDP. But then the local government debt is not low anymore. It used to be low, but now it's about 70% of GDP. But then it's difficult to look at China's debt and separate that into corporate debt and public debt. Because as you probably know, a lot of the so-called corporate debt are actually local government debt, which are also guaranteed by the government implicitly. So that's why it's so difficult to carve out, how dangerous, how big China's corporate debt is versus, and compare with that with the other countries. So the one way I looked at it is from the local government debt perspective, that the local government debt come corporate debt, the risk is still localized in China, which means that there are certain parts in China that have high risk, and that's basically the Rust Belt in China, Northeast, and the West, where heavy industries are concentrated. And because this government is leveraging, this government is trying to cut excess capacity, move away from investment-led growth to consumption-led growth. So these heavy industrial areas, sectors in China, geographical sectors in China, are at high risk because they have also high debt. But overall, when you look at the whole country, the corporate debt problem is still manageable. There is a problem there, but then it's much more manageable, I would argue, than many other Asian economies, especially because China has a closed capital account. Money cannot leave at will, but money can leave Indonesia, money can leave the Philippines at any time, right? Because they have open capital account. And then when you look at household debt in China, it's not low, but it's not extremely high. Household debt in China is about 60% of GDP, which is about in the middle of the global league when I compare China's household debt with other countries. And there is recently a survey by a major broker here on China's household. The sample size was 3,500 households that they surveyed. And the questions that they asked was simply whether between 2018 and 2019, your household's personal debt to income ratio has improved or not, your debt service ratio has improved or not. And the results came back that more than 3/4 of the respondents to that survey show that their debt to GDP, debt to income ratio, their debt service ratio have all improved. So my point here is that China does have a debt problem, but then the problem is not imminent. And because of the closed capital account in China, this problem will not blow up. I mean, there have been experts forecasting, predicting a debt blow up in China for more than 30 years. They are still predicting that, and China is still ongoing. So there are things that China needs to address, the structural problems and so on. So that's why Beijing's primary policy is to deleverage the economy. Right? So that's a structural policy direction. So putting that back into your broad question about the debt problem, that issue that comes out of COVID-19, which could create a financial crisis down the road, I think China can withstand that potential crisis much better than many other EM economies.
Thank you.
Thank you, Chi. And let me ask you a couple of questions from the audience. And
Sure.
The first question is from Alejandro Barrios, Central Bank of Mexico. And he asked, what are the assumptions for the outbreak contention in the GDP estimates presented? And a related question is related with something you mentioned during the presentation, which is the policy goal of doubling the GDP by this year, right? So will China achieve it? And if it does, how and what are the policy constraints on doing so?
Now, on the first question, the assumption for the COVID-19 outbreak behind my growth numbers, I'm assuming there's no second wave infection, which means that whatever is under control will remain under control in China. And I'm also assuming that the global pandemic will come under control by the end of May, so that the global environment will start stabilizing by mid-year. Now, if I'm wrong on that, that goes back to my last slide, the forecast margin of error, that if the global outbreak continues or if there's second wave outbreak in China, then things will go bad further. All right, so that's the assumption there. The second question about, what's the second question again, sorry?
The policy goal of doubling the GDP.
Oh, right. Now, that is a very good question in the sense that nobody actually asked about how does China define that policy goal. It sounds clear, but when I look back in the past 10, 15 years when the Communist Party first thinking about this goal, past 10 years, actually Beijing never made it clear whether it wanted to double real GDP by the end of this year or to double per capita real GDP. There's a big difference here. When I look at the numbers, if Beijing were to double per capita real GDP, it achieved that already in 2017. You look at the numbers, per capita real GDP in China. Yeah. In 2017 was doubled the level in 2010. And as of last year, China's per capita real GDP was 16% higher than 10 years ago. So that means if Beijing were to say next month that their goal was to double per capita real GDP, they achieved it. They didn't miss anything. But on the other hand, if they are aiming at doubling real GDP overall, then that's what I said in the first slide, that they would need 5.6% growth this year, so that end of this year GDP would double 10 years ago real GDP. That's overall, but not per capita. So Beijing never made it clear. So I don't really know what they are thinking, and I'm hoping that the National People's Congress next month will tell us a bit more exactly what they think. The market has always been assuming that China wants to double overall GDP, but not per capita real GDP. So there's an expectation gap here between the market thinks and what the Beijing authorities think. So that's something that we still don't know. But I'm drawing up my assumption based on the policy goal of doubling overall GDP. So that's where the pressure on more aggressive easing will come from.
Okay, so let's wait and see which is it. And regarding the easing that you already mentioned during the presentation, we have another question related with that. This one comes from Jose Manuel Marquez, Bank of Spain. And regarding easing measures, it will be possible some deregulation on some of the recent measures to control lending from platforms and big tech.
The easy measures from what, sorry?
The recent measures to control lending from platforms and big tech.
Right. Now, the lending platforms, if you are talking about the P2P platforms, they've been reined in significantly. I mean, since 2017, I think about 85% of P2P platforms have gone either bankrupt or merged or disappeared. Now, Beijing's goal is not to kill these lending platforms or not to kill the shadow bank market, because I think Beijing understands, as we do, that there's nothing wrong with shadow banking. What the shadow banking problem in China is that regulation development is way slower than the evolvement of shadow banking. So that there's a lot of cheating, there's a lot of arbitrage, regulatory arbitrage going on. That's the problem. So Beijing wants to clean out that problem, and that's why when it started to leverage in 2017, it focused on reining in shadow banking, including the P2P lending platform and other dodgy lending agencies. Now, the regulations on restricting these shadow banks, lending platforms, they have been relaxed. As my chart earlier shows, shadow banking activity has been rising. The flow of shadow bank credit into the system has been rising for the past half a year or so. So that is a very clear indication that Beijing is loosening on the regulations that tighten up scrutiny on these shadow bank activities, but they are not giving up. I mean, shelving the leveraging process is not equal to scrapping it. Beijing has not scrapped it. So I believe once when the economy stabilizes, maybe next year or later, Beijing will go back and reimpose many of those regulations, or also design new regulations to properly regulate the shadow banks going forward.
Well, and you already answered Rodrigo Leighton's question that he was asking about this regulation of SME companies. So let me go for the next question. In this forum, a lot of us are reserve managers, right? And back before the global financial crisis, most of the reserve portfolios were invested in U.S. treasuries, European governments, and Japanese government bonds. And then after the crisis, we had the phenomenon of negative yields in Europe and Japan. And we were able to avoid the negative yield environment because still U.S. treasuries were offering a positive yield. After this COVID-19 crisis, that might not be the case, right? And we are already seeing zero yields in U.S. Treasuries. And with the introduction I mentioned before, with China opening its financial markets to international investors, the fact that Chinese assets have been included in international benchmarks, both in equity and fixed income. How do you see the prospects of the renminbi becoming the next reserve currency?
Well, the renminbi is already a reserve currency, but it's a very, very small reserve currency. Global reserves, the renminbi has about 1.8%. So, but when you look at the evolution of the renminbi from being nobody, no currency in the world, to today accounting for 1.8% of global reserves, it was only about 5 years. So that was phenomenal growth. But I guess your question is really when the RMB is expected to be a major global currency like Japanese yen, euro, US dollar, and so on.
Yeah.
I wish I knew. I think that is a very, very long-term kind of development. Beijing certainly has that aspiration or even ambition, if you would. But I do not think Beijing has any time frame to achieve that goal. Beijing is being very practical in trying to promote the renminbi to become a global currency or major global currency, especially through the Belt and Road Initiative. But then the reason why I said Beijing is practical is because back 4 or 5 years ago, when I first started doing roadshows in Europe, I was making this conjecture, telling our clients that a major way that Beijing could internationalize the renminbi and make it a global reserve currency is to use renminbi in trade settlement whenever it's possible, especially with the Belt and Road countries, to fund Chinese investment overseas with renminbi. So when you look at the amount of Chinese capital outflows over the past 5 years, I don't know, we are talking about 3, 4, 5, I don't know, X number of trillions. If these were all in RMB, I think the RMB the role of the RMB as a global currency today would be much higher than bigger than what we are seeing today. But the fact is, for most of the trade settlement, the RMB is still not a major settlement currency. And then for investment that comes out of China into other countries, including the Belt and Road Initiative countries, China is still using US dollars. And the AIIB, in the beginning when it was set up, the world was concerned about AIIB lending in RMB in order to push the RMB role. But so far, the AIIB is still lending in US dollars. So my point here is that the process of internationalizing the renminbi and making it a global currency is very long. And Beijing doesn't have a time frame, a deadline that it has to hit. So my guess in the medium term, give it another 5 years, I think the RMB's share in global reserves could double or more than double the share that it is today. So that means we are looking at about 4% global reserve share under the RMB. Now, is that big or is that small? I would say that would be enough to make China or the RMB as a global reserve currency. Because look at today, what's the share of the Japanese yen and GBP in global reserve pool? 4%.
Mm-hmm. Yeah.
And they are a major currency. So I don't think it's that difficult for the RMB to move from 1.8% of global reserves now to more than 4% and just to beat pound sterling and Japanese yen as the third major reserve currency after the euro and the US dollar. But then in absolute terms, we are still looking at a small percentage. So that's the way I look at it in the medium term, about 5 years. Beyond that, I have a guess of 30 years later, after I retire, then the renminbi will be a big global reserve currency. Well, that's the direction that Beijing is looking at, and from that direction, I believe the RMB will be long-term a strong currency. Because if the aspiration is to make the RMB eventually, in the decades down the road, a major reserve currency, and if it is not a strong currency, who will hold that? You don't want to hold a depreciation currency for 30 years, do you? So I think from that projection, plus whatever Beijing is trying to do, fixing up the domestic problems and its credibility and so on, give it a few decades, it will get there. But it's a long time. It's a long term.
No, and you definitely have an advantage with all the other reserve currencies yielding zero or negative. So definitely the RMB has
Well, that's right.
Yes.
Yeah, I don't think RMB asset. I don't think RMB yields will go negative because it is not the PBOC or the Chinese authorities' policy to see negative yields, because it is very important in their system that they see bond yields, interest rate income for the people as income for the people. The Communist Party does not have a policy to take away income from people by, through negative yields. So that is still not a policy in China.
Right.
Yes.
So we have time for one more question, and this one comes from the Central Bank of Colombia, Andrés Cabrales. A lot has been said in regard to China's extreme importance in the global supply chain and the need for other countries to diminish this and have less dependency. Do you believe that this is a threat to China's long-term growth?
The dependency on the global supply chain.
Yeah.
I think it's not just a threat to China. Of course, if you recall the two slides that I show, that China is buying a lot of intermediate goods and capital goods from other countries. So that's all part of the global supply chain. So if that's broken, or if China relies too much on that external supply for inputs, whenever there's disruption in other countries, then China will not have those inputs that is needed for production, whether it's for local use or exports. So certainly that is a risk that for China. But then I think that is a global risk for everybody. Every country, every multinational companies, every production entity that is in the global supply chain. Because the global supply chain network has been built so wide over the past 20, 25 years that I don't think anyone can really get away from that risk easily by diversification even. I mean, you can always diversify. Like I've been arguing that after COVID-19, there will be a lot of MNCs will try to move away from China and invest in other countries in order to reduce the China disruption when something like this happen again. Now that is trying to reduce the risk of the global supply chain, right? But when you look at the experience, it is not that positive for that diversification, because Japan and South Korea have been investing heavily in Southeast Asia in the past 5 years, trying to move away from China to reduce their disruption risk by China in a case like this. But the problem is their heavy investment in Southeast Asia is still stuck with China, because Southeast Asia is in the middle of the global supply chain led by China. So when China is disrupted, the whole supply chain is disrupted, and Southeast Asia is also disrupted. So that the diversification benefits is not there. It's not effective. So I think this is something really needs to think through carefully in the longer term, how to manage global supply chain risk, with a disruption like this. It may not necessarily be China next time. It could be the US. It could be some other countries. It could be Japan. It could be some other countries in Asia that has a shock, and then the whole supply chain got disrupted. So, but in the short term, I think there will be a lot of companies and even countries to think about moving away from China to sort of reduce the supply chain disruption risk stemming from China. But I don't think they can run away easily.
I know we run out of time, but let me finish with a personal question. And you are far ahead on the learning curve on how to deal with this crisis.
I'm still learning.
but with how to learn how to deal with the COVID-19 crisis. So tell us about your personal experience on of how was it living in Hong Kong, seeing the virus spreading across China, then arriving to Hong Kong, the lockdowns, now the reopening of the economy, and what do you think about the way that the U.S. and other Western countries are dealing with the crisis, and what would be your suggestions for Latin American countries that we are just starting to see the COVID spreading here?
I can't really say I have a suggestion because different systems have different ways of dealing with these crises. The reason why China can sort of kept this problem under control so quickly, in about a month, 2 months, within 2 months, is that in their system they have very strict orders from the government to the people, and whether the people like it or not, in China it doesn't matter. You just have to swallow it. Right? So they can do it in China because that's a Chinese system. Yeah. I've heard a lot of complaints, a lot of grievances from the Chinese people, but overall they still obey the requirements by the government. So they lock themselves up for 2 months, going nowhere, nothing. Right? No social life, nothing. But in different systems, like in the Western world or even in Hong Kong, we cannot use the same strict guidelines or requirement because people just won't obey it. People will take to the street and protest. I heard on the news a few days ago that Germany is having protests in the street, people protesting against the government with the lockdown. Right? Yeah. So different systems have different ways of handling it. And when you look at South Korea, I mean, it's a liberal democracy. It has done pretty well in managing the crisis as well. And I think technically there are certain things that countries can do the same way. One is to have enough equipment to do the testing, medication to do the testing, enough ventilator to make air circulation well, to reduce infection and so on. And then the people, they have their own discipline of disciplining, of isolating themselves and so on and so forth. So I think that would be, as I said, I mean, the different countries have different systems to handle it. I wouldn't expect any other countries to follow China, but when you look at the Chinese model, it is quite successful, but it's quite painful too.
Definitely. Well, an honor to have you with us, and thanks a lot.
Pleasure is all mine. Thank you very much. Thank you. Thank you for the time. So hopefully next time I can come and visit you in Cartagena.
Please.
Okay.
Please.
All right. Have a good conference.
Have a good night.
Thank you. Okay.
Good
bye-bye.
Bye-bye.
Yeah.